startup founder looking to raise your first round of funding but haven't yet started generating significant revenue? Raising capital without revenue can seem daunting, but convertible financial instruments offer a flexible and founder-friendly way to structure your first round. Today at JioGenNext Academy, I'm going to break down how these instruments work and why they are a go-to option for many startups in early stage. When you think about startup valuations, it's common to hear about revenue multiple method where a company's valuation is linked to its revenue. But what if your startup isn't generating revenue yet? Or maybe you're just starting to monetize but need a significant investment to fuel your growth. How do you come up with a valuation in this case? For pre-revenue startups, a revenue multiple method simply isn't an option. This is where convertible structures come in. Convertible instruments like CCDs, or what we call as compulsorily convertible debentures, and CCPS, compulsorily convertible preference shares, safe notes, and convertible notes are widely used in the startup world, particularly in early stage funding rounds. These tools allow you to defer valuation discussion until a later stage while still raising a round of capital you need. This is especially useful because early stage valuations can be tricky. You don't want to undervalue your company, but at the same time, you need to offer investors a compelling reason to invest in a startup that hasn't hit significant financial milestones. Let's look at a real-world scenario to make this clearer. Imagine you're raising 1 crore from angel investors to fund product development, customer acquisition, and build your team. At this point, your pre-revenue and financial data is scarce. In this situation, you might use a convertible structure like a CCD to close the round of capital. A CCD is essentially a hybrid instrument that sits on your balance sheet as debt. But here's the interesting part. It will eventually convert into equity triggered by your next funding round. Until then, this debt remains at zero or minimal interest. So you are not giving away any stake upfront. When you do raise your next round of funding, the debt converts to equity based on the valuation at that time. Let's say 12 months after raising that 1 crore, your company secures its next round at a valuation of 40 crores. However, because the angel investor took on early stage risk, they get a 30% discount on this next round of valuation. This means that instead of their 1 crore converting at 40 crores, the discount is applied and the valuation for the angel investors becomes 28 crores. So their stake is calculated as 1 crore divided by 28 crore, giving them around 3.5% equity in your company. This is a win-win because your early investors get rewarded for taking a higher risk and you delay finalizing the valuation until you've had more time to grow. Pause for a second. Think about a scenario where this could apply to your business. Have you thought about how offering a discount could make it easier to raise funds while still protecting your equity? Let's take it one step further. Now let's discuss the scenario where things don't go as planned. What happens if your startup doesn't raise its next round within a specific time frame? In this case, the investor protects their position using something called as floor valuation. Typically, founders are given up to 3 years to raise their next round. If they can't do it, then CCD still converts to equity, but at a pre-agreed floor valuation. This floor valuation is usually quite low to ensure the investor gets a significant portion of the company as a penalty for the startup not reaching its milestones. For instance, if the floor valuation was set at 5 crore, the investor's 1 crore would convert into 20% equity. This is a built-in protection for the investors, ensuring they don't lose out if the business struggles to grow. Now let's explore the flip side. What if the startup does really well and raises the next round at exceptionally high valuation, say 250 crores? Without any protection, a 30% discount to 250 crore valuation would result in a very small stake for your early investor, about 0.5%, which doesn't really reflect the risk that they took. This is where the cap valuation comes into play. The cap is designed to protect investors from being diluted too much if your company's valuation skyrockets. Let's say the cap was set at 40 crore. In this case, even if your company is valued at 250 crore, the investor CCD converts at the capped valuation of 40 crore, giving them a 2.5% equity stake in the company. One final layer of complexity is that discount rates can vary depending on the time taken to raise the next round. For example, if the next round is raised within first year, the discount might be 20%. In the second year, it could be 25%, and in the third year, 30%. The idea here is simple. The longer the investor waits for the next round of funding, the higher the discount, compensating them for the time their capital is tied up. If at any time the next round's valuation exceeds the cap applies. If no round is raised within 3 years, the floor valuation comes into effect. So let's summarize. Convertible structures like CCDs allow startups to raise funds without setting a fixed valuation at an early stage. Angel investors are rewarded for their risk with discount on the next round of valuation, typically between 20 to 35%. Floor valuations protect investors if the company doesn't raise its next round, ensuring a significant stake. Cap valuations ensure investors don't get overly diluted if the company's valuation skyrockets. Different discount rates can be applied based on the time taken to raise the next round, compensating the investors for delays. Now that we've walked through how convertible instruments work, it's time to test your understanding. On your screen, you will see 4 scenarios. I want you to calculate the percentage stake the investor would get in each scenario based on the information we've just covered.